Thank you. We have the official automated word now. Well, welcome everybody. It's good to get together, at least by electronic means and so forth. In addition to the committee members, let's see. We have David Goldman.
He's the finance director.
Yeah, and Blaine is here too.
Mm-hmm.
And let's see, Byron's here. So as we normally do with our meetings and so forth, we open with public comments. So is there any comment from the public? Or Chris, did you have any written or electronic comments?
No, I didn't receive anything.
Well, Byron, you're our only public member here. Do you have anything to add?
I just want to mention that our youth sailing storage shed now is up, completely constructed. We're moved in, and it looks like it's really going to be a valuable asset for youth sailing, and I hope for the Marina. So we're up and running with that now.
Looks nice.
Yeah, it does.
Yeah, and it's tucked away in a place where it really isn't competing with any other uses or anything. It's I think it's a great idea. Okay, next item on the agenda, and if there are no other comments, is review of the minutes from our last meeting, which was February 1, I believe. No, January 11th. Or what?
No,
what?
February 1st.
Yeah, February 1st. That's right. So everybody had a chance. Everybody on the committee had a chance to review the minutes. And do you have any corrections or additions?
I think the minutes look fine, and I move that we accept them as submitted.
Okay. Do we have a second for that? Is there a second?
I'll second.
Okay. Thank you.
I'll second it.
All right, we got a couple of seconds, so we're official. It's been moved and seconded that we accept the minutes for the last meeting. All those in favor signify by saying aye.
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 And do we have any noes? Okay, the minutes of the meeting are approved. Okay, we're going to go into a discussion of the financial report. I know this is something you're all excited about, and you spent hours and hours going over the detail. So, and Chris and I had a conversation to talk about some of the issues and so forth, but we have the benefit of having our finance director with us today. And I think probably, unless there's another avenue you want to pursue, we should probably let him talk about the financial update. So Mr. No, I was going to say Mr., but I'll just say
Goldman.
Yeah. Mr. Goldman, do you have any preparatory comments or before we dive into the details?
Well, Chris sent me some questions that you had on Friday, so I can kind of go over those if you want, or I can just let you guys talk and ask me questions as you're going through it.
Well, I think it might be worthwhile if you would address the questions. I had one sort of fundamental beginning question.
Sure.
You could explain for us the column headings. It starts, just the concept looks different than a normal financial statement would from a business standpoint, but starting with an adjusted balance and then revenues and year-to-date revenues, and then there's a balance, and then which appears to be a variance, and then there's a percentage variance. Is that a fair assessment?
Well, the adjusted estimate column would be your budget column. I'm not sure why the report says adjusted estimate, but that would be your budget column. If there were any budget amendments during the year, it would be reflected in that column as well. I started late October, so if there were any adjustments for that, it would be reflected in there. And then you'll come up to the revenue column, which shows your actual revenues for that period. But since this is a year report, that revenue column will be the same as the year-to-date revenues. So if this was like in the middle of the year, let's say in June or July, you might only see June or July's revenues in this column, but then you'd see the year-to-date revenues in this third column here. But because this is the end of the year, they kind of match. And then the balance here is, the balance is basically this adjusted estimate or budget number subtracting out the revenues that actually came in. So in this particular row, I'm looking at leasehold excise tax. When you see a positive number, that means the revenues came in under the estimate. They came in under budget. They came in at 84.3% of the budget. But if you go down a little bit farther, well, this grant, all right, so there's a grant here. It's the first negative number I'm looking at, but negative usually means you're getting more revenue than your budget, but there was no budget for this particular grant. And we received revenues in the amount of $18,400. So that basically means we received a grant that wasn't budgeted, because I guess when the budget was put together back in 2018, it wasn't foreseen. This grant was not foreseen. So these are grant revenues that are coming in. Here's another grant on the next row. I think there was a question on this one. This Department of Treasury grant, that's the CARES Act money. The city got a bunch of money from the CARES Act. A lot of it went towards helping small businesses survive through the the shutdowns. The governor ordered shutdowns for COVID and all that. But and some of it went to the Marina funds. Some of it were for some purchases for Marina in the amount of $3,133. So
That's kind of an allocation of the CARES funds.
Correct. That's an allocation of the CARES funds.
Okay.
So you can kind of go through it here and just kind of see how it works. I'm not sure about this grant. There was a question on this grant here, Marina Parks grant. It looks like there was something included in the budget for this particular grant, but no funds came in for it. So Chris might have a better understanding of what was going on when the budget was put together in late 2018 regarding this grant. But I don't see any funding that has come in because of it. It might be a grant that was applied for. It just was not awarded.
What that actually is the Clean Vessel Grant.
Okay.
It used to be called the Parks Grant because it's funded by the Washington State Parks Department, having to do with sewage and stuff. So it looks like it's Washington State Parks Clean Vessel Grant. So it looks like the name was kind of split up in there a little bit.
Okay, got it.
So yeah, so that's kind of a wash. And that's about what we applied for was $18,000.
Okay, so
it's a reimbursement.
Okay, so the estimate was higher, but we okay, once we actually did the details and worked out the numbers. Okay.
Yeah.
So am I hearing then that the Clean Vessel Grant, a few lines up, and the DNR, the Marina Parks Grant, those are somehow related?
They're the same exact ones. The actual program is the Washington State Parks Clean Vessel grant. So it looks like the name was just split up when the money was received or something. They're the same.
Yeah.
Is the majority?
Sorry about that. It
Well,
just
I was going to say, was the majority of the difference the fact that changed the structure of pump outs and that sort of thing mid-year?
Could be, definitely, yeah. Yeah, it's all for what we spend dealing with sewage, from manpower to equipment, everything in between.
Okay. Anybody else have any questions on page 1? Well, actually, it's page, what is that, 8 of 47.
Yeah. I do have a few highlights I can walk through on rather than reviewing every line if you'd like.
Hey, Chris, before you get to that, I have a quick question, and you may get to it, but it was when I was reading this, one of the first notes I took was the permanent mortgage revenue. The budgeted was $666,000, and we've received over $780,000 for that period of time. So can that all be attributed to the rate increase?
No, definitely not. What that can be attributed
Okay, because I was about to say, because our occupancy has not changed significantly to the point of $120,000.
I would attribute the bulk of that difference to switching FDOC to primarily full-time regular mortgage. So this budget was written before we did that. So that's what the big difference is. Moving forward, the budget is, or the budgets that we just completed for 21 and 22 will actually be more in line with that number. But yes, this is part of the increase, but I would say the bulk of it is FDOC, definitely.
Yeah, because were we accounting for FDOC mortgage in a different location? Because the actual number of boats hasn't changed that significantly, has it?
It has in a year-round type basis. So whereas before we could only use basically half of FDOC, now we're using about 3/4 of it year-round.
Okay.
Versus a lot of them leaving in the summer just because they know they got to leave at some point. They're sticking with us the whole time.
Okay.
So yeah, that was a fantastic improvement. So because our increase was only 3%, so this is a little bit higher than that.
Before we leave the first page, there's a big number on the first page under the unrestricted area. So the beginning fund balance and the restricted account were a little over $1 million. And I think you answered my question earlier when we talked, Chris, that's was our beginning reserve.
That's the way I understand it. Can you help us out with that, David, to
Yeah,
give an explanation?
it's your beginning unrestricted reserve. There are some restricted reserves. For example, every fund has a 16.67% operating reserve that's built into it that's restricted, so that wouldn't show there. The only reason we show beginning fund balance on this sheet is because of Washington state law. We're required to show for every fund unrestricted beginning fund balance, because what they want us to show when we put a budget together is the total resources available for that year or for the biennial. So you have all your revenues, your estimated revenues that you think you're going to get for the year, and then you have your resources or your unrestricted fund balance, and that's your total resources. And then when you look at your expenses, you'll see all your expenses, and then you'll see a line that says estimated ending fund balance. And basically those numbers are just budgeted numbers that have to appear. And when we do our year-end closing, where we look at all the due tos and due froms and balance the books, then we know if any of that was actually needed to balance the budget, or if we have a surplus, it goes into fund balance. And then we do calculations of it to see, we do the 16.67% calculation to see how much needs to be restricted for the following year. And we look at other items to, we follow, the generally accepted accounting principles when we're doing the calculations.
Okay, thank you for the explanation. It's a nice number, and we've added to that at the end. Well, we'll see at the end that we've added to it again this year. And we know that it's expensive to run Marina. And we know that we can't anticipate everything that's going to happen in terms of maintenance challenges and need for matching funds and all that kind of stuff. So it's nice to see that a nice, healthy, positive number. Chris, you were going to walk us through a couple more things. Was that?
Sure. If we jump over to page 10 of 47, I wanted to highlight the ramp revenue. That was something we talked about for years, and now we're generating approximately $20,000 a year off of that. And the bulk of it is the yearly recreational. So we have a lot of people buying the year pass. And what we'll do, I was telling Ken this the other day, what we'll do is when we collect the envelopes and we start to see the same name over and over and over again, and they're paying $10 every time, we'll actually reach out to that individual and let them know there's a yearly pass and explain to them how it could save them money. So people really appreciate that a lot. So I know the Marina Advisory Committee, it took us a while to get there, but we finally got there, and it's truly paying off now. So, and then along with just above that, you can see the trailer storage, parking trailer storage is going well, as is the storage shed. So really the workhorses for the marina are the moorage, the storage sheds, and the trailer storage. Those are really our three core businesses. It could be argued that fuel sales is one of those, but as you guys know, although we generate a lot of revenue off of fuel, we're not always making a lot of money off of fuel. So, but those three are consistent, and they're month in and month out the leading producers for the marina. So. As far as the rest of the revenue report goes, we'd be happy to answer any questions. I just really wanted to point those out in the revenue section.
I was noticing that, and I shared with Chris earlier, that on page 9 of 47, up in the kind of the first third area, there's a category that says utilities, and then it says electricity, and apparently utilities, and this is on the revenue side.
Mm-hmm.
The total is aggregated, and the year-to-date number is, for the whole year, is a little over $77,000. And then if you go to page 14, I think it is 14 of the packet, it's got right about in the middle of that first group of accounts, it's got public utility services, and there's this is the expense side now. There's about $80,000 worth of expenses, but there's no comparable listing for electricity. So in one case, we've got two categories, utilities and electricity, and then on the expense side, we just have one category. So it makes it, unless I'm missing something, it makes it a little tough to track how we're monitoring and capturing that part of our revenue and expense effort. Is that clear, or did I just muddy the water?
No, you nailed it right on. The electricity is truly for the electricity revenue, and public utility services is for all of the utilities that we pay here at the marina, including Wi-Fi, our Comcast bill, water, sewer, garbage, all of that stuff.
Yeah, and we follow the BAR's account, the state auditor's accounting system for all these numbers that we're utilizing as well.
Yeah, it's just, it's unfortunate. Sometimes the categories don't match up, and it doesn't give us the level of detail to follow the bouncing ball.
Yeah. Yeah, this report here, this is, I call it the Eden report. I don't know what the city calls it, but that's what I call it. This is truly the report that I look at each month a couple of times, and that's what these reports, if you thumb through these pages and get to the charts, the pages with charts, Stephanie puts these charts together based on these number reports the Eden reports with the expenditures and revenues. So if you turn to page 17 of 47, this paints, we saw what moorage was there in a number, but this paints a better picture for me. I'm kind of visual. So in 2020, we have the number of $780,650 in moorage, but what's more valuable for me is this bar chart, this graph. It's not a bar chart, this graph showing the peaks and valleys of the year, and shows us what we can do. Also above that, we have number references going all the way back to 2016. So I can take a look at that, or anybody can take a look at this year and compare it and say, are we heading in the right category with our moorage? Are things working out as they should? And as we look at these numbers, you can see that they are. So Although the city reports are wonderful, I prefer these graph reports for the workhorses of the marina.
So, Chris, am I correct in assuming that this does not include transient moorage?
The
This is just permanent moorage.
yeah, this is just permanent moorage. Yeah.
Okay.
Hey,
Yeah.
Chris, you might know this right off the top of your head, or Mr. Goldman might have to answer this one. What's our contribution to the city this year? That's the question I always like to ask. Is it the indirect cost allocation of $110,000, or is it a combination of or multiple lines in this?
Oh, well, the indirect cost allocation, yeah, we're working on the true up now to get all the information for the end of the year process to figure out what that's going to be for 2020. I have what it was for the last 3 years, 17, 18, and 19. But that's the major one. There's some other cost allocations as well. But yeah, the main one is the indirect cost allocation.
So do you expect it to be $110,000?
It's hard to tell. It really depends on how the driving factors pan out. And we haven't finished the process yet for the year end. So I'm just looking at it right now, these interfund charges in your, yeah, you have some motor pool stuff and vehicle contributions, but the bigger one there is the indirect. It's really hard to tell if it's going to be 110, if it's going to be higher or lower. I saw it higher in previous years. I've seen it lower in previous years. So it's just hard to tell.
It's pretty nominal. I think last year I calculated at 4.3%. So indirects could be all the way up to 20%
Of what?
of the expenditures.
He's talking of the total, yeah, of the total amount that's part of the allocation from the general fund services to other general fund departments and other funds.
No, I was just talking about total expenses. So the percentage, the indirect as total expenses.
Okay, because it just so happens, coincidentally, I guess, that out of all the amount that's allocated out, 4.3% of that amount is for the Marina Fund as well, just coincidence.
Except, wait a minute, I'm missing something there. Did I miss something? We receive nothing in kind from the from the city, correct? I mean, everything that is every bit of revenue is generated from moorage, fuel, all those things that we've talked about. We receive no direct contribution from the city of Oak Harbor.
Oh,
Right.
no, the indirect cost allocation allocates the costs of, human resources, finance.
Right, I understand that. But
Okay.
yeah, I've been through this many years trying to figure out why we take $110,000 from the marina coffers and just give it to the city. And I understand that it covers the HR and it covers all, and it covers all the stuff that we would expect to, the marina employees to be able to get. But so I wonder how, I always have wondered how that cost is determined. How much, does someone just say 4.3%? Blaine, sounds like a good number. Let's just take it out of the Marina Fund and give it to the city.
No, it's based on the driving factors, and it's a calculation that I have it in front of me. I'm looking at it, but there's inputs and there's driving factors and then there's cost pools, and it all just calculates out. It's not any kind of magic number.
So HR may be number of employees. Another category might be a percentage. So it has cost drivers that drive it, and it's calculated pretty minimal. The utilities are allocated a much higher amount. So, and if you were a port authority, you would be much higher.
If we report it,
We're a port authority, we'd be having a whole different discussion.
well, if we were a port authority, we would receive money, correct?
Well, it wouldn't involve the city directly.
Right.
Yeah.
Yeah, it's it is an item that we do follow, and it has been much higher in previous years at various times. And the explanation that I heard was that it's a an allocation based on services used, whether it's a number of employees, and as David said, and the other kinds of things. They're reconciling cash. The monies that we deposit with the city that we collect from the ramp and all that sort of thing. As I recall correctly, too, there are charges if we take an item to the city council, for instance, and take a certain percentage of their agenda. We may, in fact, get charged sort of a prorated number for those types of services as well. So, it's how the state defines how we help contribute to paying the bills of the city at large.
Yeah, and some of your capital projects can incur some cost too in that formula.
And one of the reasons I was told that it went down for a while, for 2 or 3 years in a row, was that it was looking at the total amount of services used, because so much effort and manpower was going into the person power, I guess, was going into the wastewater treatment plant or the water plant, whatever we're supposed to be calling it, that our percentage became a rather small percentage of the total pie. Anyway.
I can tell you that sitting through budget meetings, as we were getting ready to talk about stuff, I had a lot of questions, and I was going to bring them up in the budget meeting and honestly complain about our $110,000, which could go up a little bit. And in those meetings, I was sitting there, and Kathy Rosen, the Public Works Director, was ahead of me. And she started talking about one of her indirect cost allocations. It might have been for water, as I recall. I can't remember each one.
It was three.
Yeah. And it was $300,000. And I was like, holy smokes, I am not going to say anything. And I didn't say anything. Because in my mind, I was thinking, we're generating a ton of money down there. And honestly, I'm not cheap, but I don't want to pay any more than I have to for these sorts of things. But after hearing her talk about it for quite a while, I decided it was in the Marina's best interest that I not even bring it up at that point, just because I was worried that might let the cat out of the bag or something. So, I mean, it's a lot of money each month, and I think we do get, services for it from finance, accounting, engineering, legal, all of that stuff. So it is much better than it was, back a few years ago. JJ and Ken, and maybe even Steve, you might remember that it was creeping upwards of 200,000, and we had several meetings, and through those meetings, for some reason, it was lowered back down to a more manageable number where it's at now. So your efforts went a long way, and they still seem to.
I think you managed the cost allocation from development services sometimes can be a challenge. And that's what happened to the one you're talking about in the street fund. So, but I think David's going to look through it. I think it's a working document, and like you said, Steve, Chris, we can work on making sure that it's reasonable.
Yeah, definitely. That'd be great.
Okay. I might bring up on page 15 of the packet, some of the our historic debt financing, of course, has been through bonds, general obligation bonds. And there are two categories on this page that show, the required principal reduction that we need to make monthly, and then or not monthly, I mean annually. And then also the interest expense. And those are both annual numbers, is that correct?
Correct.
Okay, and we may have a further conversation on debt and how we manage that and so forth.
Sure.
And because anyway, and we also have the Marina has in its coffers we were required to have $250,000 in, a reserve fund or matching fund, whatever it was,
Mhm.
at the beginning of that debt. Is that affected in that beginning fund balance number that
No,
that we're
that's
talking about earlier?
that would be a separate number. That's a restricted fund balance. That's restricted based on the bond covenants.
Okay, since it's a general obligation bond of the city, it would be somewhere else. It doesn't appear on these operating statements.
No, it would appear in the annual audit, but it wouldn't appear on the annual operating statement because the annual operating statements are based on budget.
Okay,
But it is in the annual audit, the full, the full fund balance with the restricted amounts and the unrestricted and so on.
okay. That's clear to me. I don't know. Does anybody have any other questions about that? Okay, Chris, did you have some other comments about this document?
No. I think I started to say, I think these graphs are wonderful. Again, I welcome the Marina Advisory Committee to come visit with me and review these on a monthly basis whenever you'd like to. These documents are usually ready within a few days after the first, depending upon what day of the week that falls on. And I always have them for review. So if there's any questions, come and see me. I think that, if there's no further questions about this, you started a good segue into having David talk about our current bond, the payoff, and the potential for getting another one to get going on the dredge project.
Sure thing.
Just before we do that, if I may, I wanted to highlight something on, like page 12 of this packet. There's a total, that's the total of the revenue that's reflected on this statement, that 1,000,007 number. And later in the report, at the end of the expenditures, we have about 1,412,000, I think was the expense number. So just looking at these two statements, it shows a gain. I don't want to use the word profit because that doesn't mean anything in government circles, but we have a gain, year-over-year gain of about 291,000. So that's the signal to me that we're operating within our means, and we're also able to set a little bit aside in anticipation of future projects, opportunities, obligations, that sort of thing. So I'm kind of a bottom line guy, so that's why I wanted to make that comment. So, but if there are no other thoughts on that item, we'd welcome David's comments on the financing end.
Sure. So I'm looking at the bond schedule right now on my screen, and I noticed the principal payments are starting to ramp up, and the remaining balance of the bond is beginning to go down. The bond was, the beginning balance back 10 years ago was about $2.57 million. At the end of 2020, it was $1.48 million. And then as it continues to be paid down, it'll go down by 125,000 in 21, another 125 in 22, and so on. That bonds, the average interest rate is 4.3% on that bonds. I was talking to U.S. Bank about some options, perhaps calling the bond. The bond can be refunded or refinanced, I guess, but refunded is what we talk about. That's the terminology used for bonds in June. And the calculations that they ran at about 1.85% interest showed about a $10,000 to $12,000 savings per year. And that would be over the life of the bond, you'd save about $123,000 in payments. But Chris was talking about the fact that we probably have to go back out maybe for another bond to do dredging again. And Chris, what was the number you came up with that you think we might need for that?
I think we're going to be between $3 and $4 million, probably closer to 3.5, somewhere right in there. I don't think that's out of the realm of possibility at all.
All right. So based on Well, just based on a $4 million bond, or actually I broke it down to a cost per million. So at 3%, which probably will be at the higher end of the rates right now, unless rates jump up next month or whatnot. But a 20-year at 3%, if you make the payments twice a year, for every $1 million you borrow, the debt service will be about $67,000 a year. So if you're borrowing, what is it here? If you're borrowing $3 million, let's do a quick calculation here, right? 67 times 3.
It's about 200,000.
And then if you go to 4 million, it's 268, but you still have this debt service right here on the current one. So, I mean, Chris was thinking, you do have a pretty healthy fund balance that you're building up. You have the potential to utilize that fund balance to maybe pay off the current bond, which has a pretty high interest rate in today's interest rate world, and take out a brand new bond for 20 years at a much lower interest rate. And but also you'd be taking out $3 to $4 million, so that would increase the payment a little bit over what you currently have at 2.57 million. So, bottom line is, once you diffuse that payment, principal and interest together is about 185, and then you take on this new payment. Let's say you do a $4 million bond, that's 268. 268 minus 185, that's about 80,000 more per year.
Mm.
But you'd also have to have enough money to pay off the bond. Right now, the bond's at 1.48 million. I don't know if you quite have enough for it. You may have to, maybe at the end of 21, you might be in a better place to pay it off. But yeah.
Could we use that $250,000 in reserve to help finance the paying off on the bond, or would we have to carry that over probably for the new one?
You would have to have, and we don't know if it's going to be exactly 250,000. That 250,000 was most likely a percentage of the dollar amount you did borrow. Mm-hmm. So you might have to actually put a bigger reserve away for a $3 or $4 million bond. It all depends on what's in the bond covenants.
Mm-hmm.
I think it's, a pretty common opinion right now that, obviously rates are extremely low and they're probably not going to stay that way. That inflationary pressures and other things are going to cause rates in general to rise over the next few years, at least. That's about as far as I can see anyway. So the notion of a refinance makes some sense. We haven't even done the engineering or anything relative to doing additional improvements like further dredging and so forth. And I don't know, Chris, what you're forecasting as a time frame for that sort of thing. But David, are you saying that we could refinance the current balance at a lower rate and achieve some cash flow benefit?
Yeah, that's what I'm saying. It'll save about, not a huge savings, like $10,000 to $12,000 a year for the next 10 years, but it would be at a lower rate, and you would be paying down the balance as well. So,
what would now, since it would be a new bond issue, would there be underwriting costs and all those other fees associated with that, and marketing expenses?
It wouldn't be a bond. It would be a note. U.S. Bank would write a bank note.
Oh, okay.
If it's 10 years, they can do a note. Anything over 10 years is usually a bond, and you got to go through all those expenses. I mean, these still, it's a bank, so they still built in some, about $50,000 worth of fees.
Oh, yeah.
But, it just comes with the territory, I guess.
David, it wouldn't be callable though, would it?
I don't think so. If it's a bank note, it's
a problem.
We'd have to talk to them about that, but they didn't mention anything about it being callable.
The problem is you're going to have to dredge within 10 years. That's why Chris and I are kind of more leaning towards the refinance, or paying off the old one and putting a new one on, and doing the dredging soon.
It might be interesting to hear from the rest of the committee to see how they would feel about paying that off, dropping the reserves way down, and more than likely increasing the dredge fee a little bit. How do you guys feel about that, Vin and Lady?
Well, I'll start if no one else will jump in. I think there's so many things that have to be done around the marina that are going to cost money. I'd be in favor of depleting our reserves and paying off the bond and getting a comprehensive dredging plan at a much lower interest rate. I would certainly be in favor of that. But for the fact that we're going to do concrete replacement. We really need to address the fact that our liveaboards, when it's below freezing, our liveaboards don't have any water. That is something that we have to address. The power, I know that I keep harping on power pedestals. There's so much that needs to be done. I would hate to see us deplete the reserves to the point where, Chris, your team couldn't do the things that have to be done.
Yeah.
But in the reality is we probably should deplete the reserves, pay off the bond, and get a new bond for the future of the marina in terms of dredging, because we know it's all silting in. We know we probably can't go much more than 4 or 5 more years, if that, in certain areas of the marina that just need to be dredged.
Well, and I agree as well. So if the interest rates are low, if we can secure a new bond at a lower interest rate, that just seems smart. And kind of if you move the dredging project up at all, like we talked about earlier, Chris, if you wait, if the longer you wait, the more it's going to silt in. The sooner you can dredge, the more material you can take out, and you can dredge deeper. So maybe you could stretch it out longer in between dredges just by going deeper. If that makes any sense.
Yeah.
So
Yeah.
when you say that the fee is going to increase to the tenants, and we're having this 3% come up in April again, how much is it going to increase?
It's feasible that the dredge fee could go up by half or maybe more. It just depends. Using David's numbers for 268,000 for 4 million, that's about double what we spent last time. So this would just be specific to the dredge fee, not the marina rates.
So when the old one is paid off, will the fee go down, or will we still continue to pay the higher fee to try and pay off the new one faster?
The old one will just go away if we get a new one. This will be in its place, and it'll be a new one for probably, would you think, for 20 years, David?
Well, it would be callable after 10, but yeah, you do a 20-year bond callable after 10. So in case we have to go through this again in 10 years, we have the option to do this again.
So in essence, there would never not be a point where there would not be a dredge fee tied to a slip.
That's right. That's right. But what's possible if we move forward with this sooner than later, there's the water's deeper now. For example, if we said we're going to do it tomorrow, they would bring the dredges in, and at places where we're at 6 feet at zero tide or 10 feet at zero tide. Last time we dredged, we went to a -12, was as steep as we went. The sooner we do this using the same amount of money, it's conceivable if we move the same amount of mud that our marina could end up being somewhere around 16 feet, 15 or -15 or 16. So the more time we wait, the more silt there is, and the shallower we would have to go, because it's all restricted by how much money you can spend. Does that make sense to everybody?
That was the point I was trying to make. I just wasn't as clear as you, but in my mind, it makes sense.
Yeah.
Yeah, I have an interest in seeing us pay off the current debt before we layer any more on top of it. That I made the comment earlier about, I think it's going to be a while before we can actually begin any dredging work and so forth. You've got the salmonoid issue and, all the other things that shorten the calendar when you can actually do that kind of work. And since we haven't put out that for even engineering, even for study yet, it's probably, I don't know, the last time around, I think it took 1.5 years or almost 2 years between when we decided we wanted to go ahead with dredging and when, before they were actually moving equipment in to do that. So at the moment, And JJ made a good point too about the deferred maintenance kinds of things, the damages that we see from time to time, just the age of the facility. It doesn't take a genius to walk down the main walkway and see all the crumbling concrete and so forth. I would be concerned about paying down reserves just for reduction of debt at this particular point in time. I think we need to be able to spend the money to maintain our facility properly. And that's going to probably take all of our reserves that we've been building up and so forth. And, at least in the near term, like the rest of this year, probably doesn't give us the flexibility to pay off the bonds. If we were sitting on a big enough pile of cash, I would be all for paying off the bonds. But I'm a little reluctant at this point to spend virtually every nickel we have in reserves, and to leave our maintenance schedules and so forth pretty much as is, because I don't think we could take on any significant projects or updates and rehabilitation and that sort of thing with the current state of our finances. But it is a discussion that we need to spend a little bit more time on. And I do have an interest in understanding the whole refinancing the bond thing. And, if we can save $10,000 a year, that's a pretty significant number, but I wouldn't want to bet the ranch on it.
Yeah. Steve, do you have any thoughts on that? You haven't chimed in yet.
Can you hear me?
Yeah, I can hear you now.
Yeah. I just totally agree with Ken. I think he's right on.
Okay.
Yeah,
So,
I totally agree with Ken.
Yeah.
with the lower interest rates, right now, what's the possibility of refinancing the bond that we currently have without incurring a new one, just to reduce that payment, and that would free up maybe a little bit more for these maintenance projects?
Well, that was the option that David was talking about, where we would reduce the debt service based on a 10-year note through the bank. And we'd realize about $10,000 a year.
And that Ken, that's a good option as far as I'm concerned. There's nothing that says we can't pay off that bank note at some later date, and then we're still paying what we're paying close to 4% on the current bond. And if we can get it at almost interest cut in half, I think that's I think that's a serviceable plan.
But I still have to check if there is nothing saying that we can't pay off the bank note.
Okay.
There might, they might have us locked in. So
yeah,
check back with them about that.
Yeah, it's the callable issue, isn't it, David? So yeah, if you can get it not callable, that's a win-win, because then you could do your refinancing when you wanted to.
I'll email them and see.
Right. And who knows how long it'll be before we actually. Chris, are we talking about trying to dredge in 2023? Is that the plan?
That's the plan of starting the dredge process. Somebody earlier had said it from the last time to when we started the process, working with the permitting and all that stuff, it was almost 2 years. I think that's about right. So if we start this in 2023, it's likely we're not going to dredge until at least halfway through 2024, 2025, right in that time frame.
And in the interim, we wouldn't be paying for that dredge fee. If we could retire the note or at least refinance the note on the current bond. We may have a gap there where it's paid off and we're not incurring a dredge fee to the tenants, because all we're doing every single time, we keep putting more and more on the backs of the tenants when it comes to dredging. That's it's going to be probably a minimum of a $4 million project. To do it right in the marina, to make sure that we're okay. And then we still have never even talked about, dredging in the channel, which may, eventually get to the point becoming critical, like like it did in the slough, in the Swinomish Channel. You know, but they have a commercial reason why that had to be dredged. So
Yeah,
that,
the Army did that.
yeah, because it was because of the commercial enterprise and the commercial implications of the Indian logging in the Swinomish Channel. So I don't know. I would think that if we can find out if it can be refinanced and paid off whenever, you know, without prepayment penalty or even, I don't know how it works in public, that type of stuff. I don't know.
So David, can you find that out for us?
Oh, yeah.
Essentially what we're looking at as looking to, I think you said US Bank, or some sort of like a 10-year note or something that would be, that we could prepay if we had the ability to do so. And we could do that without paying down the principal amount of that note.
Yeah, this would not be paying it. Well, we would be paying down the principal every year. With the
Yeah,
note.
but I mean, not in a lump sum at the beginning, though. We wouldn't have to reduce
Oh,
that.
no, they would just take the current debt as it is. Yeah, you won't have
Okay.
to. Unless you wanted to, I don't know.
Well, it seems like a win-win situation to pursue that particular option. And you actually just touched on something I was thinking about too. There may be an opportunity for us to say, okay, we'd be willing to prepay the balance, or reduce the balance on the note by, say, $300,000 or $400,000, and not jeopardize all of our reserves that we've accumulated and so forth, and end up with a reduction of interest, reduction of the loan amount, and
Yeah.
reduction in the interest expense.
But at these interest rates, under 2%, I don't know. It's pretty good rate.
Well, that's a good point. Yeah. When money's so cheap, sometimes borrowing is a good idea.
But let me email these guys. Let's see. Okay.
Awesome.
Ken, can I make a comment?
Sure.
You guys were talking about it being 2 years from the time we started permitting to the actual dredging, and I think looking back historically, I think it was much longer than that.
Do you?
Because as I recall, we were some of the permits we got were good for 5 years, and we were actually bumping up against the expiration of the permits by the time we finished our dredging. So that it was, we started somewhere 4 or 5 years before the scoops actually were in the mud there.
Well, that's one of the things, that's a good point. That's one of the things
I
that we
think you
need
might
to
be right.
clarify is what the realistic timeline would be for all the required studies and so forth. And we've run into this before, where oftentimes, you try to run all these permits concurrently, and then somebody in the middle will say, well, we're not going to even consider this until fisheries, or they'll kick the can down the road and say, we're not going to even look at it until you've got approval from whatever some other entity is. And maybe we can be assertive and diplomatic enough to get these things going concurrently and not run into those kinds of time delays. But that's speculation on my part, but it's a good point.
I actually, the more I think about it, I think Byron's right. I think it actually started, the whole dredge process started just before I started working at the Marina in 2007. And it ended, I had just become the interim harbor master, like with a month left in it. So I think Byron might be right, actually. But what I can do is we're working with Moffett Nichols on the breakwater repair and stuff. Next time I meet with them, I can ask them, hey, what's a ballpark on start to finish on dredging these days, and get a ballpark figure from them. And hopefully I'll be able to have that by the next meeting.
Yeah, that would be very useful information.
Yeah. So that's good.
So David's going to do some additional work on looking to refinance the outstanding balance of the current bonds, general obligation bonds. And again, that's going to be an obligation of the Marina to continue to pay the principal and interest on that note. Hopefully we'll see a significant reduction in the interest rate and therefore the interest that we have to pay. Is there any other loose ends here that we need in terms of the revenue or expense report?
Is there a chance that we?
Steve, if that's you, you've got a lot of background noise or something. You're kind of cutting out.
Yep, I'm out of.
Do you have another, Steve, do you have another device or something running right next to your station, wherever you're connected?
Sounds like he's got my old cell phone provider.
Sorry, we can't hear you, Steve. Maybe if you could jot something down in a general question directed to Chris, and he could get that out to the rest of us.
Or can you type it in the chat box?
That works too.
Chat.
Well, while we're waiting to see the outcome of that, do any other members of the committee have comments about this refinance discussion? And we are planning to go ahead with, well, Mother Nature is doing the planning as far as the need to dredge and so forth. So we will continue that as a separate effort, and also pursue this way to reduce this method to reduce our carrying costs on the current obligation. The next item on the agenda is the Marina rate increase, and we've touched on that a little bit. This is part of the 3-year commitment that we made. What was it, prior to last year?
Yeah, it was actually made in 2019 for the next.
So it affected 2020 and now 21 rates?
And 22 as well.
Yeah, 22, okay. And these rates are, in general, they affect pretty much everything across the board, don't they?
Mm-hmm. Yeah, it's 3% across the board. Some categories like guest moorage went up to round it off. I mean, we don't want to have guest moorage that's $1.12 a foot, or $1.13. So rounded it up. But yeah, for the tenants, the monthly and yearly rates, they are representative of the 3%. I'd also say that I did a survey of the marinas around us, and we're still, we're maintaining that 80% threshold of their moorage and stuff typically. So.
Yeah, for the sake of our new members, what the 80% that Chris is referring to is that we've maintained as a practice over the years, shopping the other marinas in our vicinity and so forth that we kind of compete with. And we felt that because of our location and that we have and don't have, that we should probably be at a 20% discount or from those other folks in order to maintain our tenancy and so forth. And generally speaking, that nobody likes rate increases, and certainly I don't. But that as long as we're at a discount to comparable properties and so forth, comparable morages, and we're paying our bills and actually putting a little money aside for repairs and improvements, I think it's working for us. But I'm up for discussion if somebody wants to talk about it.
Well, I mean, if it's already there, right? For 3 years, it's going to go up 3%. So there's doesn't seem like there would be that much more to talk about, right? Unless we're talking.
No, we always reserve the right to review these increases. You know, we put in place a plan, and the council approved the plan and so forth. But we also have the ability to rethink. You know, if something dramatically happened in the marketplace, or whatever,
Right.
It may be inappropriate to do that sort of thing, or maybe there's an opportunity to.
What may be worth talking about is we delayed, if I remember correctly, we delayed the increase in 2020 because of COVID. I think
Right.
we delayed it. So now we're going to have another 3% inside of 10 months. So we're going to have two 3% increases inside of 10 months. I think it might be prudent to delay, to push this one out so it happens on the anniversary of the last one. So
That makes sense.
because all it would be doing would be, we would just be delaying the total 9% increase by just a couple of months, based on what's going on with COVID and employment and shots and all the stuff that goes along with it. I would be in favor of pushing it out to the 1-year anniversary of the last increase.
Hey, I have one quick question about the 80%. So I understand the reasoning, hey, 80% of the rest of the marinas, but that's just moorage. Does that include the dredge fees and all that other stuff that we're talking about tacking on as well? Because I mean, you can't, even though it's for dredging, you can't separate it from the moorage cost. I mean, the tenant sees it as, hey, my bill is this much, you're going to increase my rate by 3% and then another 3%, and then you're going to potentially raise for another dredge. Is that dredge fee included in the 80%?
No, the dredge fee is just what it is. That's what the cost of the dredging was.
So
the dredge fee isn't affected by the 3% increase at all.
So with the dredge fee, we're closer than the 80%. Is that correct?
Well, I think Chris, let me jump in on this one. I don't think we know all the other things that are, for example, there may be some fees that Anacortes or La Conner tenants pay that we don't know about in addition to their moorage. What Chris is basing this on is just strictly moorage. No electricity, no other hidden or unhidden fees that we might not know. But we're in a different situation because we're owned by the municipality. We pay for all the stuff that other marinas don't. So you're right in the fact that our the total cost of being in the Oak Harbor Marina may be on par with everybody else, and not 80% of everybody else.
Okay, yeah, I was just trying to get a better understanding of the 80%.
Yeah. Talking to your thoughts, JJ, about putting it off till July. I think that, I know last year when we put it off till July, that created all kinds of havoc for us. We had our summer people half in the marina, half not in the marina. We were talking to people about moorage. And some people were like, well, you said it was going to be this. And we're like, well, that was before July. Now it's July, we got to charge this. We chose the April date so that the rates are set prior to the real busy season. Also, I think that, as we talk about dredging and stuff, I think it's, we're essentially giving up 2 months that we're never going to recoup now, or more than that, actually, that we didn't get back last year. So I think we've given a pretty tremendous break, and I would really urge the committee to think about how changing the rates in the middle of summer throws a big wrench in the marina operations, and just trying to convey that to people that aren't as familiar with this as some of the marina tenants are. It's a huge issue. Whereas if they come in, this is the rate, they're fine with it. You know what I mean?
Is it the transient that is a problem with?
No, no, I'm talking about the people that come in, say in June and stay through October or so. You know, a pretty good clientele of people that we have coming in. It created a pretty messy situation.
Well, we are currently operating under the assumption that the rate change is going to go in place in April. So if we were going to make a change, it would require some sort of committee action and then a recommendation to the council to make that change. So just procedurally, that's what we're looking at. So am I hearing a motion, or do we want
Well, I think we probably need to have a little bit more discussion from the members, whether they agree with me that it would be more appropriate to do it on the 1-year anniversary of the last rate increase instead of having 2 rate increases inside of 9 months. How did Jamie and Senior and Steve, how do you guys feel about that?
Is there any way to make the people that are currently paying, like the current tenants that are in the marina right now, effective on the anniversary date, and then anybody that comes in can have it start April 1st so that it doesn't throw you guys off? Is that a possibility to make it easier for you guys? Because they won't know the difference of it being the anniversary or not if they aren't currently here. I personally like it being on the anniversary, like JJ said, so it's a year apart. But I understand it being a problem for you.
Yeah, I don't think that we could split it like that. I think for a couple of reasons that would create an issue. One, just the accounting of it. But two, I would think that it would, and maybe David, you can help me out with this. And Blaine, it could be an issue for the state auditors. Why are you charging some people one rate and other people another rate?
Well, I think
I don't know.
as long as it follows whatever policy was adopted by the city, if it says that there's different rates to be charged based on different characteristics, that might be okay. It just really depends on if you're following your own policies.
Here's the other thing. I think from a business sense, I think from an equity point of view, we got to figure out why we're not applying it to one group and then applying it to another group. That's the equity issue we have to consider too. So being in a public entity, we always got to be concerned of equity. So justification of why we're doing it. Is it cheaper, the other group that we're grandfathering in?
Yeah,
you
it'd be
come up with
cheaper.
a rationale. You just got to come up with a rationale of why you're doing it rather than just ease can be one, but I think you got to be cognizant of the rationale.
I mean, I've seen
we're talking about a delay of like a few months, right?
3 months.
I don't know that it's worth,
4
going
months.
through the exercise, but that's just my feeling. We did, at the time that we decided that this was going to be a 3-year program and so forth, we did talk a great deal about this, these kinds of issues, and the predictability of increases at certain times of the year was one of the selling points. I don't know how you feel about that now, but because we already violated that when we deferred the last rate increase because of COVID-19 and so forth, from April to July, I think it was. But if you want, we can do some more work on this one and talk again next meeting, but that's, we're already into the implementation month if we start doing that.
Yeah. And last year it was the by direction from the mayor. It was his decision to do this. And
I'm just thinking the optics are it's going to create, it's people aren't going to be excited about getting 2 rate increases inside of 10 months. They're just not. And you know, this is, you know, we're the ones that pay all the bills. And I understand that it was 9 points over 3 years, and we're still doing 9 points over 3 years, just with a little bit of a delay. So I don't, you know, I don't see it. I'm sure there was an accounting issue, and it's just predominantly the summer people, right? That's what we're talking about.
It's yeah, it's predominantly the summer people, but
the
it's
small
the
boat
whole thing.
contracts. The small boat
It's-
contracts, right?
It's also the appearance of fairness issue where you
Yeah,
have, you know, essentially the same product for sale at two different prices.
Well, but we do that. The small boat contract is the same thing. It's the same product for a different rate. And you know, and you know, I don't want to get wrapped around the axle about this, but it is true that the small boat contract is a sale of the same thing that other people pay yearly for. So, you know, it is apples to apples. So.
you know, my concern is that if we do switch it to July this year, then we're going to switch it to July the next year. And again, it is such a nightmare to change prices.
Well, when somebody comes in like say April or whenever they start coming in, and they say, "Hey, I'd like to rent a slip for the summer," explain, say, "Okay, this is how much it is now, but we have a rate increase coming in July." Then if you explain, then if you explain to it as they sign their contract for the summer months, then they'll understand, right? Or no?
No, no, not generally. And it's in July. Wait, my rates went up. You said it was going to be $100 and it's 105 or whatever. No, they don't remember that. So it was really tough. So
Well,
Blaine, did you have a question?
Yeah, I wanted to kind of play the bureaucratic. So the rate increase goes in effect on April 1st, right, Chris?
Yeah,
You only have one council meeting before then, which is our March, well, the March 2nd is tomorrow, but we can't put anything on there. And then the March 16th would be the council meeting. It would go on. That's the only council meeting we have before then. Anything that Chris prepares for that has to be done by Thursday. So if you were to put that proposal, Chris, you have to make a recommendation now if you're going to do it. Otherwise, the rate's going to go and increase because it's already built into the schedule of fees, isn't it, Chris?
yeah. The legal is preparing to make the presentation on the 16th right now. So
With
they
the
are,
schedule of fees? Okay.
yeah, updating all of that as we speak.
Well, the way this works is, you know, we've talked a great deal about this, but we're not debating a motion to do something specific. And
I'll do that. Then I can fix that, Ken. I'll move that we delay the rate increase until the 1-year anniversary of the 2020 rate increase.
Which is July, is that correct?
I think it's July.
July 1, I think.
Okay, so we have a motion. Do we have a second for the delay until July?
I'll second.
Okay, motion's made and seconded. Is there, again, we kind of got the cart before the horse in the discussion, but is there any further discussion on that? Now, before I call for the vote, are we going to be able to make contact with Steve Hookey?
Steve?
He's checked off, it looks like. Let me double check.
Is he still listening or?
No,
No.
no.
Okay, we still have quorum, but okay. So we have the motion is that we delay the planned April 3% increase to July 1. All those in favor signify by saying aye.
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 Okay. Opposed, nay. I'm a nay officially, but I'm not supposed to vote. Okay, so you have that motion passed, and I'll I'll remind the members that we are an advisory committee and we don't necessarily make the final determination. We just can express our feelings to the council. So we'll proceed with that. Moving on, in the area of general update, I was talking to Chris, and he mentioned that there's been some interest by a rowing club to maybe use some portion of our facilities for support of their activity. And we've done that certainly with the Dragon Boat and the youth sailing, and kind of supported some of the local fire departments and that sort of thing. So there's plenty of precedent to do that. We're not being asked to do anything at this point. Is that correct?
No, we're not being asked to do anything at this present time. This is just an introductory, letting you know it's out there. I suspect that there'll be a formal presentation at the May meeting, potentially, where we'll be seeking a recommendation that we can take to council for them to use the marina. It's a program much like Oak Harbor Youth Sailing. There'll be a teenage aspect to it. There could be some camps like youth sailing. The one difference is that they felt like they may draw more adults from the military area, based upon the tie-in between the Navy officers and rowing and stuff like that. So right now it's a pretty vague thing, nothing concrete. We've just had some conversations. So it is out there, definitely.
Ken, can I make a comment about?
Sure.
About I actually am a former oarsman, and I was a rowing coach at Green Lake in Seattle long time ago. And there are some things that need to be considered here that I think a lot of people tend to neglect. And one of them is that rowing shells have a beam of about 22 feet when their oars are deployed, and they're long boats. Even a 4 is 44 feet long. A 8-man shell is 66 feet long. They can't maneuver within the marina. So if they're launched, they would have to be launched on the outside of the marina somewhere. They can't be, according to what tide situation is, they can't really be taken down a ramp or anything like that unless it's relatively level. And they can only be launched from a float that's about four inches or so off the water. So there's a lot of infrastructure stuff that would have to be done. There would have to be, storage much bigger than our storage sheds, or much longer anyway. And I think there's a lot of factors that people don't consider when they talk about, well, it'd be nice to have a rowing club here. So I'm just putting that out there.
Yeah, thanks, Byron. I appreciate your background and expertise in this, that there are some serious logistical and infrastructure issues with doing that. But this is kind of a heads up, just in case you hear about people, talking about the possibility of doing this. And frankly, we're not very well set up to support this kind of activity, but we'll just keep our ears to the ground and see what happens. Chris, did you have any other general update things you wanted to touch on?
No, I don't think there's anything of major importance. I was going to bring up the rowing team and some of the projects that we're working on, but their projects are just run-of-the-mill stuff that we're used to seeing. So,
okay. How about comments from the committee? Committee members that are present, this would be the time if you have issues that you want brought up, particularly for future agendas.
I have one. I have two, actually. Nice job to the marina for clearing the snow. Thank you so much. It was it was a pleasure to get to my boat that was covered in snow. But I don't know why you didn't dig all the snow off my boat while you were out. It was really, I know didn't last long, but it was really nice to be able to get out there to the boat to get the snow off the canvas and snow off the decks.
It was my suggestion that that's where they put the snow that they found.
No wonder there was so much on there.
Yeah, that was really remarkable. They came out with a snowblower all the way out to our boat because we're all the way out at the end.
It was
nice
great.
It
was great. One other thing I have we need to start thinking about this, and it really hit home when we had that rash of cold temperatures. I didn't realize that, and I knew it all along, but it just didn't dawn on me that every time it gets below freezing and we have to secure the water, our liverboards don't have any water. And we need to figure out a way to fix that. You know, we're charging our liverboard tenants good money to be out there, and there's got to be a way we can keep the fresh water running to them. So, Chris, if you could put that in your list of things that you need to start thinking about engineering-wise, we need to find a way to fix that.
I agree.
Fair to the liverboards.
Yeah, that was a tough one.
What was the time frame when we were out of water service? How long?
It was about a week.
Yeah, that's a long time. Okay, any other comments from the advisory committee? Okay, hearing none. Our next meeting is scheduled for April 5th, and in the interim, we're going to get some additional information on refinancing outstanding debt and figure out what we're going to do about the motion that was passed about the rate increase. And with that, I think that's all we covered. So with that, I'm going to adjourn the meeting and thank you all for participating.
Thank you.
A pleasure.
Yes, thank you much.
Thank you. See you
Thank
next
you.
month.
Bye, everybody.
Good night.
David, Blaine, we appreciate you being here too.
Yeah, it was, I learned a lot. Thanks everybody.
Yeah.
Okay,
Take care.
bye.